Good afternoon, and thank you for joining me for this month's webinar. In today's session, we will discuss war and market volatility. So what I really want to touch on today is how all of this market volatility and the news flow that we're seeing around the world, how it's affecting the portfolios and how we have actually positioned the portfolios for these challenging times. And then as always, I will show you the performance specifically of the default portfolios that form part of the life stage model. And then lastly, I'll end off with what our views are and how we are acting in the portfolios when we look ahead. So war and market volatility. On the 24th of February, just over a month ago, Russia invaded Ukraine. According to Putin, the aim of this mission was to demilitarize and denazify the Ukraine. Now, the biggest impact of this war, of course, is the humanitarian effect. However, in today's session, we will be talking about more of the financial and the economic impact. Now, from a direct economic impact perspective, together, Russia, as big of a country as it is, if you consider Russia and Ukraine together, they account for about 3.5% of global GDP in PPP terms and only 1.9% in dollar terms. So even though the economies really are affected at the moment, and if the GDP had to reduce by, say, for example, 10% and 30%, 10% in Russia and 30% in Ukraine, we would only see about 1/3 of a percentage point shaved off of global growth. So the overall impact to global growth shouldn't be that massive. It's really more the indirect effects that I will chat about today that are more of a concern to the global economy. If you consider exports to these countries as well, if you have a look at the charts that I have included on the right-hand side, you can see that there's little to almost no big impact to countries' exports when you consider the amount that they're actually exporting to Russia and Ukraine. The top chart shows us the percentage of total exports to these two countries. So, for example, we can see Canada on the very left-hand side, nowhere near 1% of their total exports go to Russia and Ukraine. And on the very right-hand side are countries that are closer neighbors to Russia and Ukraine. And we can see Poland, for example, just about 5% of their total exports are actually exports that go to Russia and Ukraine. And at the bottom, these exports have been calculated as a percentage of these countries' GDP. And again, even considering, the very close neighbors such as Poland and Hungary, we can see that only about 2 to 3% of their GDP is exports to these two countries. So again, the direct impact of a decrease in export to these countries shouldn't be too large. So then what are the concerns? Well, like I said, as much as the effect on global growth should not be too large, as these two countries together make up about 2% of global GDP in dollar terms, it's really the indirect effects that could be quite sizable. And two of the big indirect effects that stand out are the impact on commodity prices, as well as financial conditions. And I will chat through both of these issues today. From a commodity price perspective, Russia is one of the biggest producers of oil. So it's a major player in the global energy as well as in the metal markets. And Ukraine is a big agricultural producer. Now, if you look at the graph I have included on the right-hand side, you will see how many countries in Europe actually rely on Russia for their energy needs. The darker the green, the bigger the percentage of their reliance or the share of the natural gas imports that they get from Russia. So, if you look at how green some of these countries are, anywhere between 40 and 80% of their total natural gas imports come from Russia. So the impact, of Russia being one of the biggest producers of natural gas as well as oil is really quite large, especially the impact to the Eurozone. Now, the impacts on these commodity prices that I've spoken about, they ultimately result in higher energy prices, and higher energy prices unfortunately negatively affect growth, especially when prices rise very, very quickly. Now, I mentioned that Russia is a big oil producer. If you look on the right-hand side, you'll note that it's really Russia, the US, and Saudi Arabia that are the largest oil producers in the world. And they account for about 12% of global output. So it's not only Europe, but many other countries around the world that are dependent on Russia's oil. And as I mentioned, when the supply of oil is affected, it affects supply and demand and ultimately impacts prices. Now, when prices of electricity rise, they affect consumers, they also affect different companies. And by affecting consumers, essentially higher energy prices depress household disposable incomes. As people spend or households spend more on energy, they have less disposable income to spend on anything else in the economy. And the impact on companies is that higher electricity prices means that their input costs are a lot higher, and a lot of them may actually start to slow down production as electricity becomes more expensive for them. So quite serious implications of higher energy prices. Now, it doesn't just end at energy. The metal prices have also been affected. Russia is the third biggest producer of nickel, and nickel is used in long-range batteries. So if you think about all of these electric car manufacturers, for example, they are being seriously affected by the prices of nickel. They also account for about 1/3 of the global palladium output, and palladium is used in many, many sectors of electronics. So we've already established that, it affects the oil price. It's also affecting metal prices. And of course, I mentioned, and you would have definitely seen on TV as well, that there's a lot of concerns around how big of an impact this will have to food prices. And the reason for the effect on food prices is, as I mentioned a little bit earlier, both Russia and Ukraine are really big players in the supply of wheat. So together they account for about 1/4 of global wheat exports. So the impact on food prices is also quite sizable. Now, the chart that I have included on the right-hand side actually shows us where Russia and Ukraine export their wheat to. And we can see in billions of dollars how much they export to Egypt, to Turkey, to Indonesia, and to many, many other countries. And a lot of these countries are very dependent on those imports. They cannot produce their own. And of course, the knock-on effects can be quite large. It can impact ultimately food security. And in very extreme circumstances, it can actually cause political unrest. So I started off by saying that the impact on global growth potentially wouldn't be that large, as these two countries make up about 2% of global GDP. But as I have shown you, the indirect effects can be quite sizable. And I mentioned the two indirect effects being the impact on commodity prices. So we've spoken about oil, we've spoken about wheat, we've spoken about metals, how it will impact even food prices. And then the other indirect effect is how this then impacts financial conditions. Now, when you have all of these prices going up, it ultimately impacts inflation. It means that inflation is going up. And the way that governments deal with inflation is they tend to rise or hike interest rates to deal with high inflation. Now, even before this Russian invasion of Ukraine, we were already, post the pandemic, post all of the interest rate cuts that we saw in the pandemic, we were already in an interest rate hiking cycle. So the risk to various economies is that potentially central banks around the world hike interest rates a lot quicker than what has already been priced into markets. We don't necessarily think that will happen, but those are the risks that do remain. So what actually did happen in the markets then in February? So February was when we saw, the initial invasion. And as expected, if you look at the red bars, we can see that equity markets for the most part were negative, other than South African equities. Now, whenever there's a lot of nervousness in the markets, we saw it with COVID, we saw it with the global financial crisis, we're seeing it now with this war in Europe. Whenever there's nervousness in the markets, investors tend to sell out of risky assets and rather invest into your more safe haven type of assets. So looking at the red bars for the month of February, it should be no surprise that most equities gave us negative returns. So if you look at world equities, US equities, European equities, the most negative, again, shouldn't be a surprise. They really are closest to that conflict. The green bars represent our thematic satellites, which I'll chat about a little bit later on, but essentially these are equities as well, just categorized into certain themes. So we can see that value, emerging markets, the Fourth Industrial Revolution Fund, which is predominantly tech and innovation stocks, as well as the FANG Plus stocks, which is your Facebook, Amazon, Alphabet, Netflix, Google, they were all negative. And only really healthcare, which is often seen as a defensive sector, actually gave you a positive return for February. And then lastly, your more safe haven or income type of assets, which have been highlighted in yellow. We can see that gold, no doubt the best performer for the month of February. And again, it should be no surprise. Whenever there's nervousness in the markets and people are not quite sure what the economic outcomes will be, they tend to invest into something that is perceived or seen as a store of value, such as gold, and gold tends to do very, very well in these times of market uncertainty. South African cash, also slightly positive return, and then you can see some of the other asset classes returning slightly negative. Although these are safe haven assets, not all actually protected capital 100%, but we can see that they're also less negative than your equities, for example. So this is really what happened in February. However, I must caution you that we should never be focused on a 1 month. 1 month is very, very short term, no matter what type of investor you may be. And as a representative of the Sygnia Umbrella Retirement Fund, where the goal essentially is to provide members with comfortable retirements after many, many years, we really should be focused on the longer term numbers. So short-term market volatility, yes, does impact the portfolios, but we should always focus on the very long term. So ultimately, where will this all end? Well, it's very difficult to say. I know there's talks going on today in Turkey between, Russian representatives and Ukrainian representatives. So potentially it could end very soon, or it could continue to go on for a number of months. So ultimately, as much as we can try and have a look at what the potential impact will be on global GDP, what the potential impact will be on various prices and inflation, ultimately the impact on global growth, as well as on inflation, as well as on general market conditions in general, will all come down to how long this war actually lasts. But many analysts do say that they do believe that stocks will rally and stocks will end off, higher by the end of the year, especially if the war winds down and energy prices stabilize. We have already seen energy prices stabilizing. At some stage, oil did touch $140 a barrel. It's now closer to $112 a barrel. So it has already stabilized. A lot of countries around the globe are making a plan B to reduce their reliance on Russia. So, things are likely to normalize closer to the end of the year. And again, this should then tell us that we can expect to see a lot more market volatility. But if we are invested for the long term, if we do, the members of these retirement funds have, 5, 6, 7, 10, 20, or 30 years to retirement, then this short-term market volatility should not impact really the thinking of the portfolios and the construction of the portfolios too much when we are really positioned for the long term. So speaking about positioning, the way to position the portfolio, especially in a low growth environment or a lower growth environment, is we really have to have a very well diversified portfolio, and we think about this from a core satellite approach kind of way. So the core of the portfolio, your more traditional asset classes, we try to access these more traditional asset classes, really giving you that market or that beta exposure in a low cost manner, so passively where possible. And the pluses and minuses in this darker circle show you the current positioning or the current view. So we slightly underweight South African equities, overweight South African bonds, overweight global equities due to diversification and no exposure to global bonds. So that's really the core of the portfolio. Then, in order to have that opportunity to outperform over the longer term, we have added some thematic satellites. And these thematic satellites really give the portfolios and members ultimately exposure to themes that we believe will provide good growth to the portfolios over the longer term. So they provide uncorrelated thematic growth exposure. And these are themes such as global real estate. And global real estate really does make sense in the portfolios, as it's also seen as a global bond alternative. Now, property is often seen as an asset class somewhere between equities and income, as it does provide a stable stream of income, and for that reason, it can be seen as a global bond alternative. Continuing clockwise from global real estate, the second satellite that we have included is exposure to disruptive technologies. Now, disruptive technologies are, if you think about the companies that are in the Fourth Industrial Revolution Fund, which is the fund that we have included to access this disruptive technologies theme. These are companies involved in artificial intelligence, in 3D printing, in space exploration. So it's all of these really exciting technologies that are set to be at the forefront of the Fourth Industrial Revolution. These are really the technologies that are changing the way the world works. Then we have emerging Asia, so emerging markets such as China and a lot of the Asian economies. They're really attractive if you look at them from a long-term perspective. Some of the highest growths in the world over the next couple of years are expected to come from emerging markets economies. The middle class of these economies is growing substantially, and it's really the middle class that consumes. It's the middle class that are buying, cell phones and, consuming products and services and have the biggest impact on GDP. So for these reasons, despite some of the shorter term negative news that we have seen, especially in China, we know that they're in lockdowns at the moment. They've had tech regulations where they've been cracking down on the tech sector. If you consider these regions from a long-term perspective, they really are attractive, and they do make sense, especially from a valuation perspective at the moment, to invest into them, and especially with a long-term mindset in mind. Then health, another good theme, and another theme that we believe really makes sense in the portfolios for the long term. Now, we access health via the Health Innovation Fund, as well as a healthcare ETF. This is global healthcare that we're talking about here. In fact, all of these satellites are on the global side. And health is attractive because not only have we just or are still busy coming out of a pandemic, and a lot of the vaccine producers have been, at the forefront of all the innovation that have been able to provide us with, vaccine and provide the world population with a vaccine, and they have, of course, benefited financially from this. But there's also a big focus on healthcare because the world was kind of caught off guard with the pandemic. There's a lot more spend that's going towards healthcare going forward. We're finding that there's aging populations, especially in the developed markets. And the reason why these people are able to live longer and longer is thanks to the advancements in healthcare. And lastly, the innovations happening in the healthcare space are very, very exciting. There's a lot of technology that's being used to better healthcare, to make it more accessible. And those innovations are really exciting in that space as well. And then the last satellite we have there on the left-hand side is value. Now, value as an investment style tends to do very, very well when there's a rising interest rate environment. And as I mentioned a little bit earlier, we are in a rising interest rate environment due to the fact that rates were cut so aggressively during the pandemic in order to support the economies. Now economies, due to the higher inflation, are in an interest rate hiking cycle. And when interest rates rise, value companies tend to do much better than growth companies. Now, growth companies are more your tech type firms. So if you think about like a Netflix or an Amazon, these are growth companies. A lot of their valuation or their pricing or the share price that is determined by, these future earnings. So what they promised, to kind of earn in the future. And when you have a rising interest rate environment, you're discounting those future earnings at a higher rate, making them worth relatively less today. Value companies, on the other hand, they're not growth companies. They're very established. It's your blue chip type of companies. A lot of these are dividend paying stocks, and an interest rate hiking cycle or interest rate rising environment makes them more attractive because the value of the company is day to day. It's not based on a lot of these future earnings. So we have invested in value on the global side as a value style. And the way we do that is by investing into certain indices. And these indices basically are indices of stocks that are value stocks, or stocks that have lower price to earnings and lower price to book ratios than others, or than the industry standard. Value is not meant to be a very long-term strategic type of satellite to the portfolios. It's more there on a shorter-term basis, really to take advantage of the current market environment. Whereas the other themes really are there because we really do believe in these themes from a growth perspective. So if you think about healthcare, if you think about emerging markets, these really are long-term themes in the portfolios. And the way to invest in, really any, market environment, but especially in more of a volatile market environment, is really to have a very well diversified portfolio. And we know that across the ranges, we invest across various asset classes. Of course, the 40 portfolios being less risky than your 70 portfolios, but across all of these portfolio ranges, you can see that there's a blend of equities, bonds, income, money market, as well as global equities, bonds, and cash. So we do invest across various asset classes, and this provides good diversification to the portfolios. This is the strategic asset allocation of the portfolios. In addition to that, we do practice tactical asset allocation, whereby we do take advantage of certain opportunities in the market, or depending on the current market environment, we may tilt the portfolio in favor of certain sectors. Now, the Signature range of portfolios is a blend between active and passive management. If you look at the equity space, the South African equity space, we do have the Sygnia Swix tracker that gives you that passive exposure to the market, that low cost exposure to the South African market. And then you have your active managers such as 91, Coronation, and Visio, and we have recently added Laurium to that lineup as well. And they really are the active managers that can provide that opportunity for outperformance in the South African equity space. In the bond space, also a blend between active and passive management, where Sygnia is the passive manager that just tracks the all bond index as closely as possible. And then Coronation is the active manager that really can take active bets in the bond markets as well. And then you can see, the managers that we use on the income and money market side, less exciting in terms of asset classes, but good diversification there nevertheless. And it's really on the global side, where if you think back to that core satellite slide that I showed you, it's really on the offshore side that we see this thematic investing playing out. So you see your exposure to value, your exposure to China, your exposure to emerging markets, all playing out on the global side. In the skeleton range of portfolios, again, very well diversified from an asset class perspective, but the way that we access these asset classes is purely on a passive basis, meaning that there's no active managers in these. The skeleton range of portfolios really is there to save as many costs as possible, and still providing you with that very well diversified global balanced portfolio. So you can see that all trackers are used on the local as well as the global side being exactly the same lineup of instruments that you saw in the Signature range. And then the Synergy range. The Synergy range is the range whereby we outsource the decision-making with regards to asset allocation, as well as share and bond selection to various South African asset managers on the local side, and on the global side, it's exactly the same as the other two ranges. So on the local side, you'll have Allan Gray that manages money together with Coronation 91 and Prudential. So the decision is then outsourced to them with regards to both asset allocation as well as instrument selection. Now I will move on to show you the performance of the portfolios as at the end of February. But before that, I just want to start off with just going through again what the default investment strategy is of the Sygnia Umbrella Retirement Fund. And this default strategy is a life stage model implemented by the Board of Trustees. And each participant in the umbrella fund, each employer then gets to choose between one of the three different life stage models. In addition to what members will be defaulted in, members can opt out of their default if it doesn't suit them for whatever reason, and they can create their own investment strategy. They have 18 different portfolios to choose from. There's no limitation with regards to how many times they can switch. So if they want to switch, a few times a year, they're more than welcome to, although of course it's not advisable, and it is advisable that they do speak to a financial advisor before making the decision to switch. And we don't charge any switching fees. The life stage model, regardless of which range is chosen, works on a glide path that starts de-risking members 6 years before retirement. So all the way up from the time that a member starts working at a company, they could be, in their 20s, right up until 6 years before the retirement, they'll be defaulted into the 70 portfolio. The 70 portfolio has approximately 70% invested in equities. And then as they get closer and closer to retirement, we will automatically transition members to a more conservative portfolio. So they'll move from the 70 to a blend between 70 and 60 to the 60 to then a blend between 60 and 50, right up until 1 year before retirement, when they will be 100% invested in the 40 portfolio. The 40 portfolio has about a 40% exposure to both local and global equities, implying that the other 60% is invested in safer type of asset classes such as bonds and cash. So this is the glide path of the life stage model. And each employer can then choose whether they want to follow the low-cost passive skeleton range, the passive and active blend, which is the Signature range, or the active balance range, which is the Synergy range. I did explain these ranges a little bit earlier, but these graphs always, really help to kind of visualize and really understand what the portfolio construction differences are between these ranges. The specialist approach is what we follow in the skeleton and Signature range. So a specialist approach means that we start with the asset allocation up front. Sygnia makes the decision on that asset allocation. So we decide the percentage that should be invested in local equities, in global equities, in bonds, in cash. We decide on that percentage up front. And this decision is based on, many factors, our forward-looking views on the markets. We have assumptions of where we believe asset classes will be over the next couple of years, where inflation will be. We look at various indicators. So taking that all into consideration and knowing what we're trying to achieve from these portfolios. So for example, the outcome that we want to achieve might be CPI +5 for the 70 portfolios. We then come up with an asset allocation. Once we know exactly what percentage should be invested in local equities, for example, we then go and look for the best ways to implement on that local equity strategy. And in the signature range, that's a blend between active and passive management. In the skeleton range, it will be just a passive component. And the type of managers that we look for in the specialist approach would be managers that are skilled in specifically managing that asset class. So if you think about the signature range that has exposure to Coronation, 91, Visio, and now Laurium, we have specifically looked for managers that have proven themselves to be really specialist in managing South African equities. Likewise, in the bond space, in the signature range, you've got the Sygnia Passive Bond Fund, as well as the Coronation Strategic Bond Fund. So Coronation have been put in the portfolio due to their skill in being able to manage South African bonds. In the skeleton range, you just have the passive tracker. So essentially, the specialist approach, you start with the asset allocation up front, and then you look for the best way, the best managers and strategies to implement on that decision. And then in the synergy range, which is your balanced approach, we divide the portfolio between the number of asset managers. So that will be your Allen Gray, your Coronation, your Prudential. They each get a portion of the portfolios, and then the decision of asset allocation and then share selection is then up to them. So they can decide how they want to invest between equities, bonds, property, cash, all of course within the restraints of Regulation 28. So really just a difference in our construction approach there. And if you have to look at these portfolios from a risk and return perspective, risk being on the horizontal axis, the further right you look, the more riskier portfolio is. We can see that the 70 portfolios, as well as the single manager portfolios that are there available as member investment choice, are on the higher risk side, but we do expect a higher return from them over the long term. So investment theory tells us that we should be rewarded for taking on higher risk over the longer term. Your medium risk portfolios are your 60 and 50 portfolios, your low risk portfolios, your 40 portfolios. That is why they're suitable for members that are 1 year before retirement. And then the ultra low risk is a money market fund that's made available for member investment choice. It's ultra low risk, but on the return spectrum, on the y-axis, you can see that you're not expected to get a very high return out of money markets, and you're certainly not able to have inflation plus beating returns if you just invest in money market over the long term as well. So how have these portfolios performed? So despite all this, scary news around what happened in February and what continues to go on with the war, what we continue to see on our television screens every night, if you look down the column of February, we can actually see that the portfolios did okay in February, all positive returns. And over the 1 and specifically over the 5-year numbers, which we should actually be focusing on, we can see, really good double-digit returns across the portfolio range. And importantly, all 3 of the portfolios in each category, the 70, 60, and 50, have been outperforming the strategic benchmarks across all of these periods. So portfolios really, really doing nicely against their benchmark over these measurement periods. How did markets do? So this is quite a busy slide. It's got a lot of numbers. So the few numbers to focus on, I'm specifically going to focus on the 1-year numbers for today. We can see if we look down the 1-year column that it's mostly positive, good returns that markets gave us for the 1 year to the end of February. Couple of things to point out. Firstly, quite a big difference between the return of the SWIX and the capped SWIX index. The reason for this difference in return really comes down to regulations in China. You may ask, well, how do these regulations in China affect the local market? Well, it really comes down to Naspers and Prosus, which are 2 companies that are very big in South African indices. and they ultimately are affected by their own, big portion of Tencent, which is a Chinese company, and tech regulations in China, where China was cracking down on tech stocks and putting a whole lot of rules in place for gaming companies, affected the share price of Tencent, which ultimately affected Naspers and Prosus. Now, the SWIX was more exposed to Naspers and Prosus than what the capped SWIX was, and that is why over specifically this 1 year measurement period, we can see that the index that was more exposed to Naspers and Prosus was more affected than the index that was less exposed to them. So in the capped SWIX, the holdings of companies are capped, so you have a smaller exposure to those two shares. Over the long term, you can see that it has been better to rather be invested in the SWIX, and we continue to hold that view. Something else to point out is property. So property has also done very well over the 1 year, giving us 22.4%. So definitely, a good, healthy, double-digit number. However, if you look at February's return of -3.3, as well as the 3 and 5 year number, you can see negative returns. So this positive return for specifically this 1 year measurement period really comes down to property as an asset class coming from a really low base. At some stage, it was down -50%. So coming off that low base, it has provided a good return over the 1 year. Now, our portfolios have not been exposed to property, which has served us well over the 3 and 5 years, served us well in February. However, specifically looking at the 1 year measurement period, when you compare the performance of the Skeleton and the Signature range of portfolios that had no allocation to properties to some others in the market that did, then we have underperformed on a relative basis. And then lastly, just looking at global markets, the MSCI World Index in South African rands measures the performance of developed markets. And we can see that in rand terms, developed markets gave us 13% for the 1 year to the end of February, whereas emerging markets, unfortunately, down -8.9%. And this really, again, comes down to all this volatility that we saw in China, China being the biggest component of these emerging markets indices. But despite the, negative return, as I mentioned, from a valuation perspective, it really became even more attractive. And from a forward-looking growth perspective, we still think that investing in emerging markets makes sense. So you do have that exposure to emerging markets in the global portion of the portfolios. Having a look at how these have performed over the long term, what this graph measures is how 100 Rand invested once back in May 2012 would have grown. And now we can clearly see that whether you invested at 100 Rand in the Signature 70, Synergy 70, or Skeleton 70 portfolio, it's done quite nicely. It's that 100 Rand has definitely grown. It has not grown without volatility, which is exactly what we expect when we do invest a big portion in equity markets. And what we can clearly see is that all three of these portfolios have comfortably outperformed the black line. And the black line is the global large manager watch median, which is the median performance of the managers listed at the bottom. Now, as you can appreciate, these are all very well-known asset managers. They've been managing the time and fund money for a very, very long time. So if you're able to outperform the median, then your portfolio has done very, very well. So all three of the 70 portfolios doing really nicely over the long term. And now looking at the surveys, the Alexander Forbes surveys that compared like-for-like portfolios as at the end of February, we can see that in the low equity multi-manager survey, which is where the 40 portfolios fit in, we can see that over the 6 months, the last 6 months, the portfolios are really doing very well at the top of the ranking tables. Over the 1 year, the Signature and Synergy portfolios doing very, very well over the 1 year. Skeleton a little bit further down. at 11.2, but really over the long term, having a look at the 3, 5, 7, and 10-year numbers, we can see that the 40 portfolio really doing nicely. Top performance over the long term from the 40 portfolios when compared to similar portfolios in the markets. So all of these portfolios have roughly, 40%, let's say, in South African equity. So they're all low equity in nature, and that's why they're in the low equity survey. The low to medium survey is where the 50 fund fits in. Again, over the 6 months, we can see really good performance, only 0.2% behind the top performer if you look at the Synergy 50 fund, and then Signature and Skeleton a few basis points below that. Over the 1 year, however, we can see that the portfolios are closer down to the bottom of the ranking tables. And this really comes down to the lack of property exposure. And we saw property did very well, as well as, the choice of tracking the SWIX over the capped SWIX. And the SWIX did have a lower return than the capped SWIX. So managers that, or portfolios that track the capped SWIX have done better, and active managers. So a lot of these portfolios do have active managers. In their active managers are actually benchmarking themselves against the capped SWIX as well. So we understand where the differences over the 1 year come from. And as always, should be focused on the longer term numbers. So again, looking at the 5, 7, and 10 years, we can see top performance from these portfolios. Similar story for the 60 fund. We can see that the 60 fund slots into the medium equity survey. And again, over the 6 months, the performance, especially of the Synergy portfolio, only a couple of basis points behind the top performer. Over the 1 year, in the bottom half of performers. And this really, again, exactly the same reasoning comes down to property and the type of equity exposure on the South African side. But focusing on the longer term, you can see over 3 years, these were the 3 best performing portfolios. And again, over 5, 7, and 10 years. And then the most important portfolio, arguably, is the 70 portfolio. This is the portfolio that most members spend the majority of their working lives being invested in. We do find that most members do use the defaults, the trustee defaults, and the default chosen by the employer, and would be, invested in the 70 portfolios, right up until 6 years before retirement. So over 6 months, we can see that Synergy and Signature, in the top kind of quartile of good performers, Skeleton a little bit further down. Over the 1 year, closer down to the bottom, all 3 of these portfolios in the bottom half of good performers. The higher the allocation to equity in the portfolios, the more pronounced this effect is of, which equity did you actually invest in? Did you track the SWIX? Were you in active management that's benchmarked against the capped SWIX? And the bigger the property exposure was in some of these competitive portfolios. So the bigger the impact and the more aggressive the portfolio is. Over 3 years, though, you can see that that's starting to normalize. And also in absolute terms, if you see the differences in actual percentages, Signature 70, for example, at 13.1, whereas the best performer there is at 13.5. So only a 0.4% difference. And these are gross fees. So on a net fee basis, arguably, these lower cost portfolios that have a big portion, invested in passive, would definitely be, further up on a net fee basis. And then especially important for the 70 portfolios is really to focus on as longer term as possible. So looking at 5, 7, and 10 years, we can see this portfolio is doing very nicely. And over 10 years, the Signature 70 portfolio has been the best portfolio in this high equity multi-manager category, giving us 12.5% annualized return. You can also see that over 10 years, there's less competitors in the space. You have to have a real and actual track record to be included in these surveys. So some of these other portfolios that haven't been around for full 10 years, unfortunately can't participate in the 10-year survey. And then always interesting to compare how these very well diversified, multi-managed kind of portfolios stack up against the single managers. And we can see that over the 6 months, it's only really Alan Gray and 91 that are at the top. Over 1 year, a couple of asset managers have outperformed. A lot of them have underperformed. But the longer the measurement period, so looking at 3 years, it's only Coronation that stands out. Over 5, 7, and 10 years, it's only really Coronation and 91 that actually stand out as these consistent good performers in the surveys. And we can see that, the Signature and Skeleton range really are at the top of the ranking tables against these single managers across all of these measurement periods. Bearing in mind, of course, that some of these very well-performing managers, such as Coronation 91, have been included in the portfolio construct of both the Signature as well as the Synergy ranges. But even Skeleton 70, that's totally low cost and passive, one of the best performing portfolios over the long term, again reminding you that on a net fee basis, the Skeleton portfolio would move up, quite a bit, as some of these other portfolios can be, especially some of these single manager portfolios can be quite expensive if you take into account, the management fees, the performance fees that they charge. So the Skeleton portfolio would definitely move up. And then lastly, in the comparison to others in the market, we have chosen to show you a 7-year multi-manager scatter plot. As if you look at a 10-year one, there's just not simply enough little dots to compare against because there's not enough competitors in this space. As I mentioned, you have to have a real and actual track record to be included in the survey. So 7 years is kind of the time frame where we find the most competitors in the space, and it's as long as term as possible. So in a retirement fund, again, with the long-term thinking in mind, we should be actually looking at a chart like this for as long a period as possible. And the way to interpret this risk scatter plot is for every level of risk that you see on the horizontal axis, you would want the top performing portfolio. So looking at the 40 funds, we can see that for that level of risk, if you can see where my mouse is at the moment, for this level of risk, somewhere, just below 6% as measured by standard deviation, these have been the top performing portfolios. Likewise, for the 50 and 60 funds, for this level of risk, somewhere around 7, 8% as measured by standard deviations, these have been the top performing portfolios. And importantly, the 70 funds, where we do expect majority of members to spend a lot of their working lives being invested in, for this level of risk, these have been some of the best performing portfolios. Anyone plotting underneath, so looking at Skeleton 70, for example, anyone plotting directly underneath Skeleton 70 has taken on the same amount of risk as the Skeleton 70 portfolio, but has not achieved as high of a return if you look at the corresponding return on the y-axis. The more extreme portfolios are the ones to the right, and these portfolios have taken on even more risk than your Signature and Skeleton 70, but have not been rewarded for that risk taken if you look at their corresponding return. So overall, looking at the full portfolio range from 40 to 70, Synergy, Skeleton, as well as Signature, the portfolios are all doing really, really nicely for the level of risk that they take. And then just to end off today's session, we started off speaking about war and market volatility and how we need to be positioned in very well diversified portfolios. We need to have this long-term mindset in mind when we're investing for the purposes of providing for members' retirement. So ultimately, we continue to watch the news very closely, to monitor the situation closely. We're not making any knee-jerk reactions. So it's not to say that now that there's a war, we need to exit markets altogether. We do keep that long-term investment mindset in place. We're trading very carefully. Of course, all of this market volatility does provide some good opportunities in the markets. So we're taking advantage of those select opportunities, trading very carefully. And then, of course, lastly, mentioning it again, that we are staying focused on the long term. So with that, I want to thank you for your time this afternoon. I do have a few moments and I'll be happy to answer some questions. There's a question that says, what do the number of plus signs indicate? Now, if you remember that core satellite approach slide, and please forgive me for flipping through so many of these slides now, but if I may just go back. If we go back to this core satellite approach slide, you'll see that, especially when you're looking at the satellites, you'll see some of the satellites have one little plus, whereas emerging Asia has 4 of them, value has 3 of them, health has 2 of them. So the number of pluses that you see is the relative overweight position that we have in that thematic satellite. So global real estate is quite a small overweight exposure. Disruptive technology is quite a small overweight exposure, but if you look at emerging markets, our allocation to China funds, our allocation to emerging markets funds, and generally to that Asian region, it's quite a large overweight. Value as well, quite a large overweight as exposure of the global portfolio. And this overweight is relative to the benchmark, which is the MSCI equity. So relative to that global benchmark, how overweight are we in these specific themes and sectors? Hope that answers your question. There is another question that asks, could we possibly get copies of the slides shown? What you will receive is a email a couple of days after this webinar that will have a link to the recording. And when you watch the recording, you'll be able to see all of these slides. There's reasons why we don't necessarily share the full slide deck. If there's a particular reason why you might want a certain slide, please do get in contact with me directly. And depending on which slide it is, maybe I'll have a look at whether I'll be able to share it with you. I hope you can appreciate that a lot of this information does have our IP, and we don't want it, circulating necessarily around the industry. But if there's something specific that you want, please do get in touch with me. Okay, I don't see any other questions. If you do think of something that was unclear or something that you might want more information on, please do get in touch with us after this webinar, and I'll be more than happy to assist you on email. I want to thank you again for taking time out of your very, very busy schedules and spending this 1 hour with me, and hope to see you at the next one. Thank you.